on the screen? Because Bob's giving me a...
Welcome, welcome. Right now we have Nanex Live. I am joined by Mr. David Cullum and Eric of Nanex. Eric has some specific examples. This is a follow-up passage to our little session that we did for an hour and a half about a week and a half ago. So without further ado, I'll turn it over to Eric, and David will be the main questioner. I will largely shut my mouth. Eric.
Dave.
Yes, sir.
Okay, so can you see this my screen with the...
I can see your data. No problem. Let her rip.
Okay. All right. So this was an example sent to me by somebody, retail trader, who wanted to buy 10,000 shares of this stock called DHY, which is listed on the American Stock Exchange, which today is called NYSE Market, and he put in his order before the market opened with a limit price of $2.79, and the first problem that he noticed was that he didn't participate at all in the opening price.
Right. So zero fills. That's what I'm seeing. Zero fills.
Right. So I've tried to remove anything extraneous that doesn't really add to the discussion on this spreadsheet. If I put all the data in, it would be pages and pages and pages.
Got it.
So I'm only going to show the bid and bid size from Amex. This column here is the size change. So we can see if there's any orders added or subtracted.
Okay.
Over here on the left are the results of trade executions, and I'm only going to show trade executions on the American Stock Exchange and what's labeled here as NQNX, which is a dark pool. We don't know what dark pool. You with me so far?
I'm with you. Yeah, I'll
Okay.
interrupt you if I'm confused.
You'll tell me if you're confused?
I'll tell you if I'm confused. I'm just listening. I'm with you.
All right, so here we go. 9:30 in the morning, market opens up, and he sees that 42,168 shares trade at the price that he wanted, $2.79. He didn't get any of them. And he watches and he sees other prints coming through. So this is many minutes later, actually 20 minutes later, he gets a fill from his retail broker for 130 shares.
Yeah.
Now, what's interesting about this is that this is coming from a dark pool, and right before his trade prints for 130 shares, there just happens to be 130 shares that execute on a dark pool at $2.79.99. And what else is interesting is immediately after that trade execution, we see that the size bidding at the American Stock Exchange drops by 200 shares. Now, the size will always be in round lots or even numbers of 100.
Right.
So that would correspond, that 200 drop would correspond to 130 shares executed.
Okay.
But the trade is printing on a dark pool, yet it's the American Stock Exchange's bid that's decreasing.
Okay.
So his order isn't sitting there at the American Stock Exchange. His order is sitting at some internalizer out there that's trying to game his order and essentially try to make this spread at his risk. And the internalizer has placed the order at the American Stock Exchange. And he made the spread here, this $279.99, and he's willing now to execute 130 of those shares, and he subtracts out from his size.
Right.
So our retail guys got 130 out of 10,000 shares done, and I'm going to scroll it up a little bit as time elapses. And we'll
So
see other trade.
Saying that according to your screen, it looks like there's a ton of shares available at 279. Is that right?
Yeah.
So they're sitting there. They're available. They're not.
No. He wants to buy too. So he wants to buy at 279, and there's a lot of others that want to buy at 279.
Okay. I got it.
Now this is a cheap stock. This stock's trading at $2.79. It looks like a lot of shares, but it really isn't a lot of dollar value. And this stock typically trades in a very tight range all day long. So we come down to the next execution here. He gets a fill from his retail broker for 100 shares. Right before, like 10 minutes before his fill for 100 shares, somebody else is buying it for $2.79 and 1/100th of a penny, 8,000 shares.
Yeah.
And then his print comes in about 10 minutes later. Now, after his print, he's getting filled on a dark pool.
Right.
The American Stock Exchange bid drops by 100. It's as if his order was sitting there on the American Stock Exchange. Okay. And a couple minutes later, he gets 5,700 shares, prints out a dark pool, not at the American Stock Exchange, and again, immediately, the American Stock Exchange size changes by, oh, look at that, exactly 5,700 shares. And then the same thing happens down here at 1031. He gets a fill for 3,275, and magically, the Amex bid size drops by the same amount, rounded to an even lot. So what's happening here is that the internalizer has taken his order and is trying to make a spread. And if he makes the spread, he makes the spread. And if he doesn't, he'll dump it off on this retail order. Essentially, what's going on here is that he's stealing, this internalizer is stealing time from this retail order.
Okay. And so if you look at it just by price, you'll say, well, he got his order filled. Well, yes, he did this time. But if the price had ticked higher, you would have missed his order.
He wouldn't have been filled. That's correct.
Well, what saved this retailer is that the price that he happened, it took about 2 hours to fill.
Right. Right, but he should have been filled on the open, right?
Right.
He should have been part of that open.
And so they were attempting, basically stalling it to see if they could grab. I'm not a trader. Grab the bid-ask gap.
Exactly. He wants to make the. So this internalizer is actually selling here at $279.99. To some retail, it's the same thing is going on the other side, where some retail guy is trying to sell at $280, and some order comes in to buy at $280, and this internalizer comes in and says, "Oh, you know what? I'll give you 1/100th of a penny cheaper."
Right.
And so he steps in front, and now he's just trying to make that spread. He's trying to sell it at $2.79.99. and buy it back at $279.01. See this order right here, that 1013 for 8,000 shares? Yeah. This is somebody who wanted to sell it, probably sell at a limit of $279.
Right.
So if this internalizer wasn't allowed to jump in front of it by 1/100th of a cent, guess who would have been filled? Yeah. That would have gone to our retail guy. So he got cheated out of time. So he didn't lose money on here. He lost time.
So let me interject here now. So on a slow, sleepy day like this, there is no consequence, really. But in a situation where the market is getting volatile, the retail guy gets totally hosed. Is that correct?
Yeah, I think in a marketplace that is focused on microseconds,
right,
and you're asking a guy to wait hours?
Yeah, pretty weird, actually. But if you hit one of those flash crash moments where the thing's dropping through price levels, the retail guy's going to get left behind. Is that correct? His order, it will just go right.
Right. So if this thing suddenly took off,
yeah,
he'd never be filled. You'd have to chase the price higher.
Let's say, let's turn around. Let's say there's a seller, and he puts in a sell at 279, and the price is quoted at 279.
He'll get filled.
He will get filled, even in a sell-off.
Well, if you are willing to cross the spread, you're going to get filled. You may even get this extra hundredth of a penny.
Okay.
But if you want to be at the limit price, if you want to join the bid or offer, you are not going to participate equally. You are going to be leaned on. Your order is going to be stepped in front of by people who could do that at prices that you cannot.
So the retail guy here then, again, in a volatile market, will simply be left out of the trades altogether.
Right.
So the trade will move away from him, and even though he had it, and if I put in an order for a stock to buy down to 279 and it ticks down to 279, but the thing's not parking there, I'll just never get the fill.
Right. So if you want to get filled, if you want to get messed with the least, the way to do that, the best way to do that is to pay the spread and make sure the size of your order is smaller than how much is displayed. So if somebody wanted to sell in the example right here where 26,200 are bid at 279, you could probably get off maybe 15,000. You could probably sell 15,000 at 279 and get filled of all of it. I doubt you could get all 26,200.
Okay. Okay. So
let's move to options, unless you've had more questions on this one.
What I'm trying to do is figure out where the little guy is exposed to micro scalps, where the little guy, my big fear would be, let's say I put a stop loss order in. I've got the stock. I'm saying, if this thing drops to 2.7, I want out. And my concern is that it, and again, I don't even use stop losses, so that I'm speaking for the guys who do. My concern is that with these kind of delays, that the market could drop right down through 2.2 and just skip me. Is that possible?
Absolutely. So let's talk about the stop order. Who has the stop order? So let's just say there's a dozen exchanges out there. Where's the stop order? Is it being held by a retail broker? And how does that stop order get triggered to actually turn into a market order and do something? Right. Or is it held on by the internalizer?
So people think that if they put in a stop loss order, they've mitigated risk. They think that they say, look, my worst downside is 2.7. If there's a sell-off,
stop limit, right? So there's two kinds. There's the stop, which converts to a market order,
right?
Which we found out what happens to those on May 6, 2010.
They get crushed.
Or there's the stop limit, which again becomes one of these limit orders once whatever mechanism is in place. Now let's say the retail broker is holding on to it, and they're processing a slower feed, and it's really busy, and they're behind. I don't know. Fidelity was behind minutes on that day.
Well, that's helpful.
So by the time their software is processing and sees, hey, the price is below, or I need to convert this stop order into a market or a market limit and get that to the exchange, that's an eon later.
So the other thing I would worry about personally would be a situation where all of a sudden I got nervous about the jumpiness of the market, and I would put in a market sell. Excuse my loose language. There is a sort of a language here that traders know. But if I put it into sell at market, My concern would be if someone would park on that order and wait till the thing tanked in 500 microseconds later, and then fill the damn thing at a ridiculous. I could be the guy who sold it at 1 cent.
Well, what's more likely what's happened is the stock is already tanked by the time you see it, and your reaction time is longer than a few hundred milliseconds.
Right, but these guys. So these guys, back to the beginning of your talk, you said that there was a buy order, admittedly not a sell, that sat on the exchange for 2 hours.
Right.
Concern would be if these guys can park and stuff for hours, the odds of me getting caught by an air pocket are huge. Or
right. Right. You market risk. So that's this is the whole thing that gets missed with price improvement. So somebody would come along and say, well, this guy who sold got an extra 1/100 of a penny for his 8,000 shares, and that's great. Isn't that wonderful? But right. we're not thinking about, what about the guy who wanted to buy at 279 and wasn't able to because this guy jumped in front of him?
Yeah,
that's not right.
It isn't right, but at the same time, as you said, the retail guy can put in a market order, and as long as it doesn't go bananas, then what will happen is that it will get filled.
Right. You can't try. Right. You are definitely taking a risk when you're at the limit, and it is not just market risk you're taking. You're taking the risk that an internalizer will try to front run you as long as he can.
Right.
And you will only be filled. You will only be filled when the price is going to tick against you. So you can almost be guaranteed that after you're filled, you will immediately see a loss.
And that's because they can stall until they get you to lose.
That's right. As soon as it's about to flip to the next tick lower, they're glad to fill you.
But so the flash crash in May 6th of 2010 took a matter of minutes. And the question then is, were retail investors who were trying to put in orders sitting at their computer with their fingertips, were they getting not filled? Were they just...
They were behind by at least a minute. CNBC was behind by...
they're behind by 10 years.
Right. And they didn't know they were behind that far. I mean, Dow Jones's computers that were calculating the Dow Jones Industrial Average was behind by 90 seconds. It was a mess.
You know, the historical backdrop to this is that one of the things that caused the real challenges of the market crash in 29 is that the manual exchange, admittedly it was much slower, fell behind, and once the traders realized they were behind, they said, I have to get out of this market. So it came back to the integrity of the market. Once the faith in the integrity of the market was lost, then everyone said, sell at any cost. You got to get me out of here. And I worry about that, right? I worry about the loss. I posted a Volcker quote today, which he basically says we've got to maintain integrity here, or all will be lost. And so in 29, as soon as they fell behind by hours, and people just started putting in sell orders. They said I got to get out. And I don't know if in this modern era that sort of thing can happen. But I worry about that. I don't worry about the retail guy who loses some pennies per share, because I think there's people out there who are determined to get those pennies. That's just my view. I worry about the retail guy who gets much more seriously clobbered. And I don't even worry about the retail traders. And I'll tell you why I don't worry about the retail traders. I think they're stupid. I think anyone who swims in that shark tank and thinks that they can sit there and click their F keys fast enough to win at this game are just asking for trouble. But I do worry about the guy who just wakes up in the morning, puts in a market order, and it just doesn't get filled, and then he finds out at the end of the day it got filled 20% lower. That's what that would be a serious problem. That's possible. Is that correct?
Sure. Yeah. Every day this happens. Every day there's there's a large cap stock that suddenly moves up or down 5%. We're talking in seconds, and we're talking every penny up and every penny down.
So, again, we talked about this before. One day Berkshire Hathaway flash crashed to $1. I don't know if they unwound those trades or not. They
did.
They unwound those. So if I put in a buy order, let's say Microsoft's trading around 40. I can't remember because I don't care. But let's say it's around 40. I could put in a buy order at 20. Thinking if something bad happens, maybe I'll grab some shares. What a great idea.
No, that's not going to happen. And I'll tell you why.
Unwind them, right?
Because where's your order going to go? It's not going to go to the exchange. And if it does, you better hope you're one of the 12 exchanges that price falls down through.
Right.
For example, when APC went from $90 to a penny, if your order wasn't sitting on the NYSE book, you did not participate.
I see. So you can have wild differences in prices then.
Oh, absolutely. Yeah, it's roulette. This is not the kind of market. This is not anywhere near how eBay works, for example.
Right. There's no buy now button. not a valid one.
Yeah, this is eBay with a random factor thrown in.
I see bats up there.
Yeah, so this is what's happening in option contracts, and this is problematic here, because this is one of many examples that I've recently been sent, that I've tracked down, where in this particular example, this guy wants to buy 202 tap 85 calls, and he puts his order in when he sees 330 are offered. And he ends up getting 173 of those. 157 of them were canceled. Now, this is not an egregious case. This is a typical case. And when we look and see what happened here, there ended up being 20 events. This was all within the same millisecond or two. And there's all these exchanges out there now in the options market, which there doesn't need to be all these exchanges. It's all just to fragment and allow this sort of behavior to go on. So the American Stock Exchange had 36 offered, BAT 16, CBOE 49, Gemini 30, ISC 83, Miami 49, NASDAQ Boston 22, NASDAQ 18, Philadelphia 27, Pacific or ARCO didn't participate, neither did NASDAQ or Boston, and neither did C2. And when we look to see who canceled, we find that this is where the order got filled. He got 27 on Philly. But before that, we see 6 gets canceled from this exchange. And then all the way down, these are all getting canceled out.
So that's the case where the trades ran away from the buyer.
This is exactly the example. This is the Ford example that I detailed last summer, which was what Michael Lewis followed up with in Vanity Fair.
Right, but this is the case where the 27s that filled, the 27 option contracts that filled, triggered the cancellation of all the others because
right.
of the time.
That's right. So basically, a market order is unable to execute as fast as these guys can cancel. Now, the thing about options exchanges is most of them are all in the same location.
Right. So they're not really in those cities?
No, no, they're not. They're all.
Okay. At one point they were, though, right?
Yeah. So it's like a lot of them are in the same, are housed in the same rack, or the same.
Right. So there's gigantic.
Not the same rack, but they're very close to each other.
Yeah, Lewis talked a lot about, the guys that positioning their relative to basically the doorway so that they would get the fastest response.
Yeah, here's an interesting story about that. So when they first started co-locating, they had 3 racks that were positioned close, and medium and far. They're like lined up, and everybody wanted to be in the first rack, and no one wanted to be in racks 2 and 3. And this was back a while ago when people weren't really thinking about speed of light. And so what the exchange did to be able to use the real estate in racks 2 and 3 was they said, okay, we'll just give everybody a 1,000-foot cable, and the guys in the first rack will just coil up that cable, and the guys in the second rack will coil it up a little less, and the third rack will go straight through. Well, now all the guys wanted to be in the third rack.
Why?
Because in fiber, when light has to go around a curve, it bounces off the walls and ends up being a tiny amount further.
So you wanted the straightest cable.
That's right.
You wanted 1,000 feet from the door.
Right.
Did we talk about that tower that got auctioned off last time? Do you remember that story from last week? There was a radio tower. Bob, you're shaking your head no. There was a radio tower in England.
Yeah, we didn't cover it.
It was dead real estate. It was this old radio tower. It went way the hell up in the sky. And they went to sell, and they thought they were going to get about $200,000 for the real estate, and the thing got bid up to $200 million.
Right.
And they didn't know that these were basically, traders trying to get that altitude out of that tower.
Right.
Yeah, I'm going to build towers now. I've decided that's going to be my next.
Well, yeah, well, your business will be wiped out if they ever come to their senses and just house instead of fragmenting your marketplace.
So you assured us last time that these guys are not going to cannibalize away their profits and basically put themselves out of business. Not in your opinion. Because that's what I was hoping. I was hoping that these guys would basically get to the speed of light and they'd all just basically get nothing.
Right. It's the 1,000-foot cable. If that wasn't there and when the exchange had them pay up to have a shorter cable, then you would see one winner emerge, winner take all emerge very quickly, and then you would see outrage from the ones who weren't the winner. And then we would see reform.
A couple of questions about options and stuff I'd like to ask you. Now I don't know where your skill set goes and where it leaves off. If you said, oh, Dave's a world expert chemist and started to ask me questions about chemistry, you would quickly discover what I don't know. But let me ask you a couple. One of the things is during options expiration week. What's the third Thursday in the month or something? When do options expire? The standard equity options.
Friday.
Friday, the third Friday of the month?
We have weekly options now, so every week.
So what used to happen, and I want to know if there's truth in this or if this is a bunch of crotchety traders who haven't a clue what they're doing. The claim used to be that the options market, that the equity markets would go bananas like 3 or 4 days before expiration. By trading equities, they would drive the price to the point where they would completely maximize the pain of any options traders. Is that true or not? The max pain point. This is urban legend. They say if you take the equity, so let's say you can see all the options. You say what price of Microsoft will leave the options traders most destitute at the end of the period?
I doubt that. Maybe for smaller stocks. Maybe for smaller stocks that you could be pushed around. That's not going to happen with a big cap.
The internet, I'm told, is all fact, but I'm not sure I believe it. So I have another question you may or may not know about, and that's the definition of liquidity. You used liquidity last time, and I got it. Your definition was basically when there's shares to be bought or shares to be sold, the sort of the depth of a market. Microsoft would be very liquid in most circumstances, and then something like some penny stock would be very illiquid. I got into a discussion with the VP of the St. Louis Fed, believe it or not. And why this guy's willing to chat with me, I don't know. I try to make him not pay for this thing. But we got into it. We got into a discussion of liquidity in which we were clearly using different definitions.
Right.
So he was talking about liquidity like it's dollars in the system, and I said, well, that's one liquidity. But then there's a third one, and that is there's the repo market and valid collateral within the repo market. Do you know anything about that kind of collateral issue, this idea that the Fed is scooping up all the valid collateral, and so the repo market is starting to destabilize? Does that ring a bell to you?
That's out of my...
Okay, I will let that one go. That's fantastic. I know people chatter about it, but I also know I chatter about stuff I don't know what I'm talking about. So that's that doesn't, just because people are chattering and pretending like they know something doesn't mean squat. Do you follow the Forex markets?
Sure.
Are they getting nuts? Do you see instability in the Forex markets?
Do you remember the dollar flash crash?
The dollar flash crash, yes, vaguely. They tend to be small. No,
yeah.
They tend to be smaller though. They're not like the equity flash crashes.
They're not?
Well, they're not. You don't go dollar to yen by a factor of 99%, do you?
Oh, well, you go by 5% in a few minutes.
That's what I mean by smaller. Now, if you leverage 500 to 1, you just got crushed.
Right.
So yeah, that's a great picture of the dollar flash crash. Yeah.
Yeah. Well, it's if you converted before and after your dinner, it's half the tip.
Yeah, it's more than half the tip.
Well, if you're in Europe,
Yeah. Okay.
That was significant. I mean, it was actually so significant that it tripped the circuit breakers in the. So here, if we go back all the way to 2009, this is all the price changes from midnight and Euro futures, and this was the black is the day of the dollar flash crash. And so when it got to that point, it would have gone a lot. It would have actually gone twice as high, well, not twice as high, but another 50% higher if CME's new stop logic wasn't in place. I think I have a chart of that.
That gets us to a second thing. There's this idea that the markets are now safe because they have tripwires.
Well, look at this. So here's the CME Euro currency, the 6E's, the symbol. You see that flat line there?
Yeah, that's the trip.
Okay, so I inverted the dollar here so that we could compare them.
Yeah.
This is something they added in December of last year.
Okay, but this gets another critical point, and that is that so if you have a serious sell-off and you trigger one of these shutdowns, that can cause serious anxiety and a serious backlog of selling.
Absolutely.
Right, and so then what happens is then all of a sudden the sell orders really start picking up speed because, again, if you can't sell it when you want to sell it, they exacerbate the market that's still open. It's like you'd have to coordinate everything that depended on that, and for currencies, that's very hard to do. So we could have something crazy like a flash crash that crashes into a close.
Yes,
right?
That's the most dangerous time.
That's the most dangerous, and a Friday flash crash would be truly unbelievable. Because now I remember the first hint of flash crashes I got once was a flash something. Kodak moved $4. This is a long time ago. Kodak moved $4 in a 200 share trade at the end of the day.
Right. Those are when one small order ticks the price is not the same thing as when 1,000 orders walks the price up or down a penny at a time.
So if we had a Friday afternoon flash crash in which it didn't have time to recover, so that the pinheads on TV weren't able to say, and everything's fine now, there'd be a lot of chattering that weekend and potentially very dangerous open on Monday. Correct?
Yes.
So then I would expect Monday to have a bunch of, actually Sunday night when Asia opened, I would expect there to be a lot of central bankers out there blathering about how they've got our backs. Right? You there?
Yeah, I'm there. I'm Roger.
It's amazing how sober these central bankers get when they leave. Did you by chance catch, and Zero Hedge picked up on this, they catch the panel discussion of Greenspan, Fisher, and Lindsay? It was an hour panel discussion, and Greenspan, Fisher, and Lindsay all sat up there and told nightmare scenarios about how screwed we are, as though they had nothing to do with it themselves. Now, Larry Lindsay I give credit for, because years ago, I don't know if you remember this, but the Fed minutes got released during the dot-com bubble. And Lindsay was bearing down on Greenspan, saying, you know, we're going to find out how bad this works. So Lindsay was basically telling the Fed govs that, and that came out, you know, in the minutes 5 years later. So Lindsay's not a bad guy, I think. Fisher, a lot of people call him a hawk, but I think he's like all the other guys. He talks out of both sides of his mouth. But these guys were talking about a catastrophic situation, the economy, the debt, and the markets are in. So if
more than what happened in 2008?
Well, yes, I sense that they're saying these guys sounded like, you know, Tyler Durden meets Bill Bonner. I mean, these guys were talking doom, and I'm just staggered by the fact that these guys have the audacity to go out there. So
maybe they didn't know the mics were on.
Probably one of those. What's that guy? What's that economist who screwed up Obama by saying how they lied about Obamacare? What's it? Gruber. They're pulling Gruber. They probably just didn't. Oh, you know, we're being videotaped, but no one will listen, right? Oh yeah, there's no such thing as YouTube. Okay. China? Let's talk about China. China under the auspices of the algos. Is China being traded by the algos?
Yes.
So that's a time bomb.
There are a lot of interesting things that happen with in Chinese stocks, in the Chinese futures, the futures that track the China index.
And so there are companies in China, just for the people who are not paying attention. And you say, well, what do I care about China? I don't know China. Well, you know, we're still getting effects from the Nikkei from 1989, so we should care about China. And
we are?
Yes, we are. They're dead in the water. They're stinking up the place. China's got a blue water navy now, right? And so I think China is a risky situation. There are stocks in China that are up 2,900% in months.
Well, it's their turn. You know, it's their turn to have a nice internet bubble. I mean, they're fun on the way up.
Oh yeah, except I can't ride them. You know, these guys who think they can ride them and get out, and you know, eventually a pile of them gets slaughtered. A lot of dead guys along the way. Do you think that my wife's beating on me from both phones? Do you think the German bond market's going to have an accident here soon? I don't even know what causes these accidents, but the German bond market has been selling off hard. I call it getting their buns kicked. And they've been selling off hard. And a lot of times you get the hard selling before you get a real crash. It takes some selling pressure, and then all of a sudden that's when all of a sudden people say, "Get me the hell out at any price." And the German buns have dropped like a stone so far.
I don't know. I'm if it happens over longer than a period of a day, I'm pretty much I'm not your guide.
Okay. I'm a low frequency trader. I change about once every 10 years.
Oh, me too. So I'm the same way as far as
question. What do you do with your money?
Index and over time.
And are you 60-40 kind of guy?
No. For my retirement account, it just depends.
Your nest egg.
It just depends on. No, I would say there's some of it's balanced, but if there's an opportunity that comes along, I'll go all in.
Okay.
But that doesn't happen often.
You do move in and out like a game of Texas Hold'em a little bit.
Yes, but like I've only played a couple games.
Right. Okay.
For a long time. I mean, I like to get the 10-baggers that Peter Lynch used to talk about.
Yeah, right. Yeah, they come along every day. Except in China, of course, they do.
Well, they come along if you have the patience to wait. I mean, no, my last.
You know these. Excuse me, the BTFD. Am I allowed to say douchebag, or do I have to put something else in?
You can say whatever you want, Dave.
No, you shouldn't say that, Bob.
No, you can't.
So these guys who say, you know, that there's never a bad time to take a profit, that's total crap.
Because you're right. You'll never get until you've had something that's gone up tenfold. You really don't. It's hard to grasp. I mean, it can wipe out a lot of mistakes.
Right.
A lot of mistakes.
But, you know, my dad was a buy and hold guy. And he bought, you know, Carrier Corporation when it was a tiny little company, and he just sat on. He bought GE in 1955, right?
Right.
And when the market was incredibly top heavy, and I was telling him, Dad, you know, this whole thing's going to go, and GE was higher than it is now 15 years ago, right? But how do you tell a guy who's up 100-fold that he should sell? And
right, because it could drop in half, and it's still just a tiny.
Yeah, right, it's not buy the dips. It's BFD, big deal. And so the guys who sell, right? All the guys who made 100-fold on Microsoft, they have one common trait, and that is they didn't sell.
That's right.
So I happen to know the guy who took Microsoft public. He's a good friend of mine. And I asked him, was Microsoft always a no-brainer? And he said, oh, not at all. He said when they first went to put it together, they had a bunch of these spastic, you know, techie types. They were trying to figure out how they were going to structure it.
It was always overpriced, too. That's what I always heard, you know, because I've been in the market and writing software since the 80s, so we're very familiar with Microsoft. And
right, so he said, so this friend of mine is Rick Sherland, in case you pay attention to the analysts. And he said, no, they had a number of near-death experiences that could have inspired the most prudent of investors to get the hell out of there. And so these big scores, they don't come from, you know, moving in and out of the market. They come from buying and holding. And the trick is to do a Gretzky, is go where the puck's going to be and park.
Yep.
And so I'm glad to hear that you're a low-frequency guy, even though you're watching microsecond time scales. So if you were going to go into an induced coma for 10 years, and you had to hand your money over, I'm tempted, by the way. You had to hand your money over to someone and say, hey, put it in this for while I'm gone. Where would you put it?
Google and Elon Musk.
Oh man, you're nuttier than I thought. How about?
Hey, gents, we need to kind of bring it to a close here, I think.
I think we're there.
Thursday.
We are coming back Thursday with Joe Saluzzi. The same group is going to reconnect on Thursday. Same bat time, same bat planet, btfdt.tv. And at 4:30 p.m. Eastern Standard Time, we're going to have Eric, David, and Joe Saluzzi of Themis Trading is going to join us as well to basically talk more on the same topic. Gentlemen, anything that you'd like to add before we sign off today?
I'm good. Thank you very much for the time.
Well, I appreciate the fact that I can get one of the true Brain Trust members to come on and answer my incredibly naive questions, hoping that maybe I'm speaking for Joe Sixpack, but they're probably sitting back there cackling at me too. So.
Well, I'll tell you from my perspective, David, and I don't think I just fell off the turnip truck, but you know it hit me in the head. I learn a lot from these conversations, and Eric, I really greatly appreciate your time and effort in coming on. It is hugely important to me. And I'll tell you, our last conversation was viewed by about 400 people. So even though it has a relatively small footprint, it is an influential footprint nonetheless. So again, I thank you both. Again, folks, we're going to be back Thursday, June 11th at 4:30 p.m. Eastern Standard Time with the three of us and joined by Joe Saluzzi of Themis Trading. Thank you both very much for coming. Bye.
Bye.